It's all about tax planning on this Wealth Wednesday. Investment specialist Yvonne Delry and senior wealth advisor John Fraioni from First Ontario Credit Union and Aviso Wealth join us now with more. And you know, it's tax time. People are doing their taxes. Yes. It's something we should be thinking about all year long, but it's ways to lessen that tax burden.
Yeah. So right now, I mean, people are sprinting to the finish line. So I brought in John Fraioni. He is one of my colleagues, and he's got 20 years in the industry. But we have to remember that taxation is such an important part of our social system in Canada, in all levels of government, to pay for all of those services that we rely on. We don't like to pay taxes, however, it does pay for all those social services, and we need to learn what the tax laws are so that we can implement them for our specific situations. So we're going to talk about capital gains, capital losses, and retirement income equalization.
Okay, so let's start off with capital losses, John. What is that?
So capital losses are very important to understand. A capital loss or a capital gain is generated when you sell a capital property. Capital properties are usually personal use properties.
So it could be your home?
A secondary home.
A secondary home,
yeah,
okay.
Not your primary residence, but a secondary home or stocks or bonds or mutual funds. Any of those sales could generate a capital gain or capital loss. To figure out whether you've generated the capital gain or loss, you take the sale price minus the purchase price and any expenses that were put through on that purchase. And if you have a gain, it's considered a capital gain. If you have a loss, it's considered a capital loss.
Okay, so how do you reduce those taxes owing on a capital gain or a capital loss?
So when you're looking at having a capital gain, the capital gain has to be paid in the year that it's generated. So you do have to claim that on your income taxes. A capital loss can help reduce that capital gain by allowing you to subtract it in the year that you use it. Now, if there's an excess in the capital gain, excess in the capital loss, you can carry it back 3 years, but you can actually carry it forward indefinitely.
Okay.
Right? So it's a great strategy to help you minimize your tax burden on any gains you've earned. And given the volatility we've experienced over the last few years, especially in the markets or even in the housing industry, it's definitely a good strategy to understand.
Right. It's almost one of those weird occasions where a loss is a good thing.
If you have a gain.
In a way, if you have a gain, yes,
yeah.
yes.
Yeah.
Okay, so Yvonne, let's talk about retirement income splitting then as another way of tax reduction.
Absolutely. So retired couples can income split. And basically what income splitting is transferring income from the higher paying or the higher income earning spouse to the lower income earning spouse. If you are over the age of 65, you can split up to 50% of your registered pension payments, so any pensions that came from a former employer, RRIF payments, or RRSP annuities. If you are under the age of 65, you can split registered pension payments. CPP sharing. So this is where if spouses agree, they can share their CPP payments. The ratio is what was earned in CPP while the spouses were living together, up to 50% of their payments. So we really want to increase after-tax earnings. Mm-hmm. This is not only to reduce income tax, it is to perhaps increase OAS payments for the family and any of the social benefits where the calculation is based on income. So you could get higher social benefits if you have reduced income. So talk to your tax specialist.
Okay, because there's a lot to cover here.
There's a lot to cover.
We have run out of time, so we'll get all your links up on our website, chch.com/morninglive. Thanks for joining us. Nice to meet you, John.
Nice to meet you. Thank you.